or paying to the lawyer, time value of the money and all those stuff. You find out, so you just ignore that one. Big companies, if small losses, yeah, they can call their lawyers or something. If still cannot find them, then they just cut off their sales on any business terms with that customer, and that's it. But if the money is big, worth it, then this, sue the customers and try to go for liquidation process of its properties and all those stuff and recover the money, right? But if it's too hectic and all those stuff and you are losing more money by collecting the small amount, then just you just charge the expense and that's it. You just forget about it, right? Because you are dealing with billions of dollars, so $1,000, $3,000 doesn't matter to you. Okay. So it based on your experience, you find out that okay, 1% of my sales are not, they don't pay us money. So you make a reserve of 1% of the sales. So it means 1% of sale is not going to be collectible. So 99% of the sale is collectible. So you base your cash budget based on 99% collectibility, right? So you record uncollectible expense if the actual expense will be charged to allowance, right? Whenever we make an allowance, entry would be allowance expense to, uncollectible expense to allowance for uncollectible. Remember, the uncollectible account would be the contra account for account receivable. Like we have discussed in our previous discussion, that we create depreciation allowance, which is the contra or opposite account for the assets, long-term assets, in which depreciation expense directly go over there, right? Similarly, this one is contra account for account receivable, right? It's a reserve. So we set up a contra account here. So amount of receivable business expects that it not be collected. That is uncollectible allowance or allowance for uncollectible accounts, right? Let's just talk about its treatment. First of all, the allowance method, how we write it down, the allowance on the balance sheet. So under account receivable, you see here, we just less allowance for account receivable. So here, 500 you need to recover from your customers. You realize that 25 is not going to be recovered, so your total account receivable is 475, right? 475 here. Here we go. You can also write it down. Account receivable net of 25 is 475. It means 475 plus 25, answer would be 500. 500 is your total gross account receivable, in which you have maintained 25 of allowance, and the rest of the amount is shown here. It means we are reasonably sure, not 100%, anything can happen. We are reasonably sure that we will be receiving $475 from our customers, right? Now, allowance methods. There are two types of methods: percentage of sale method and aging of receivable methods, right? So first, let's talk about the percentage of sale method, and for aging, we will be having some break. After that, we will be talking about the aging method, okay? So first of all, try to understand the percent of sale method. Both methods are same, but there is a little trick here. So the simplest method is percentage of sale method, in which you see your history and you see that, okay, if we sell this much account is receivable. So you see from your past, 1% is, collectible, uncollectible. So you make a reserve for 1% of sale, that's it. And we call this income statement approach. Why? Because percentage of sale method, sale belongs to income statement. So that's why we call this income statement approach. Similarly, aging receivable method, receivable belongs to balance sheet, right? So that's why we call this balance sheet approach, right? What does it mean? We base our uncollectible allowance based on income statement. Why? Because sale is presented in our income statement. So we took the sales from income statement and then we see that how much, is the uncollectible. So we make a percentage, that's it. So aging method will look at the account receivable that is presented on the balance sheet. So that's why we call this balance sheet approach. Here we go. So percentage of sales method, simple. Sale multiplied by percentage of allowance for uncollectible or estimated uncollectible. We call this uncollectible account expense, which means this much gonna be not recovered from this sales. There's a trick here. So this gives you uncollectible expense. If this income statement is for, if this income statement is for 2021, so it means 2021 sales multiplied by the percentage, whatever you have decided or from your history or whatsoever. For example, is 2%. So 2% from income statement of 2021 is not going to be recovered. So that become our expense. That will directly go to income statement in uncollectible expense. But we are studying here allowance method. So that is not allowance. That is expense. And then we add whatever allowance we are having, we add it, we find out the full and final figure. Let's see here. So we have a percentage of sale, method based on the illustration here. So let's just see that. Here we go. So let me adjust the control here. Yes. So let's do this in example together to further clarify how allowance for uncollectible is going to be found through percentage of sale method. So assume it is it is September 29, 2012. And Apple Incorporation accounts have these balances before the end of the year adjustments. So we are in September 2012 and we have a balance of this account. Remember, allowance for uncollectible is contra account, so its balance would be opposite to the natural balance. So natural balance for account receivable is debit. So the natural for contra account would be credit. So they already have 10 reserve. It is in million, so it means they already have $10 million in allowance for uncollectible account. And their account receivables are $11,028 million. Right? Okay. Suppose Apple Incorporation credit department estimates that uncollectible expense is 1% or 0.0005 or 1/20 of 1% of the total revenue. Through their history, through some mathematical formula or something, they find out that it is 0.005 of the total revenue. So their total revenue is $156,508 million. So what would be the entry of the reserve account? First of all, you multiply 0.0005 multiplied by this much, that would be your expense. From $156,508 million, $78 million is not going to be recovered. What will be the entry? Remember, this is not the actually that happened. This is your forecasting based on your past, based on your percentage of sales method. This is not the actual expense. So that is a trick here. That's, some students, they can question, or the question gonna be in your mind that how you know that it's gonna be 0.005 of the revenue 156,508, right? You sell right now, customer gonna pay you back the money. So in advance, you find out that 0.005% as 0.005 is not going to be recovered from the sales of $156,508 million, right? So this 78 is going to be our expense. So what is the entry? Expense increase, debit. So it's going to be uncollectible account expense to allowance for uncollectible accounts. So this is not the actual one. This is that we estimated, we reserve, so that our planning is not going to be disturbed. So we don't plan on the basis of 156,508. Now we can plan 156,508 minus 78. Understand? Everyone? Harry, Marilyn, Nam, Pinyo, Dion. Are you getting it? Guys, answer that. Marilyn, Nam.
Yes.
Understand? Yes. Harry, understand?
Yeah.
Okay, good. Now, what will be your, okay, so Dion, I get your message. Okay, good. So, what will be our total allowance for uncollectible? 78 plus the balance here, right? So our total uncollectible is going to be $88 million. $78 million is because of the sale of 156,508, right? That's it. Right? So if you post in your T accounts, in your ledger, that would be, we have nothing to do with the account receivable because this is an allowance method, so our accounts receivable are not disturbed. Allowance for uncollectible, entry would be that it is credited, so 78 million here, and uncollectible account expense is debited, so it is debit side, 78 here, right? Okay, for the aging, let's just meet after 15 minutes so that we can easily digest what is the aging. It's at a little bit, a difference from the percentage of sale method. Just going to give you a taste here. In percentage of allowance method, we have found estimated collectible multiplied by the sales, and here would be allowance, here would be uncollectible